Today, guys, we have a great guest. We have Decade Investor. I'm going to pick his brains on investment. He's going to do a quick introduction of himself, but let me just give you guys a quick overview about him. Decade Investor, you can find him on Twitter at Decade Investor. I'll post all that on the description. You'll also see it under his name. But he is a 23-year-old investor, and his investment style is a bit different than mine. So let's get started. So Kolin, Decade Investor, right? I'll probably just stay with Decade Investor to kind of keep the brand.
Okay.
So Decade Investor, 23 years old, right? Congratulations on your portfolio. It's doing amazing. One thing I try to talk about in this channel is there's multiple ways of investment, right? There's no one way of investing. Everybody has their own method, and it's better to find what works for you. For me, I'm more of a growth style investor. I see you're more of a dividend investor. And there's always some form of stigma or negative trend. I saw a recent Twitter post of you there. A lot of people consider your investment style something an old person would do, right? Someone might consider my investment style something a more riskier person would do. So I feel like you always hear attacks from different sides. But I want to know a little bit more about you. Just a quick introduction of where people can find you and how did you get into dividend investing?
Yeah. So, like you said, my name is Kolin, but my social media where you can find me is Decade Investor. I created that name I used to do YouTube. Well, I do YouTube now, but before I started the social media accounts, I would always say on my YouTube videos, I invest for the long term. I hold for decades. I'm a decade investor, and so that name kind of stuck, and that's where I moved to Twitter and Instagram to create those social media accounts. That's where I stuck that Decade Investor name. And so I really started learning about investing when I was in high school with my mom. She works in finances, but more about just understanding and just a curiosity of, where do these people, you see wealthy people, right? We see them in the news. We read articles about them. Warren Buffett, is obviously the top when we think of investors. We look at them and we wonder, how did they get there, right? What did they do? Or how can I, replicate what they did to maybe move towards where they are? So it was more of like a curiosity play of, a young kid who's 16, 17 years old, just wondering like, hey, how can I be where they are? Or how can I at least get on the path to where they are? And so that's where I started learning about investing in general. When I first started investing, I always tell this story. I started with $400 and I put it into 4 different stocks, 4 different companies. I could tell you the stock tickers because I went back and looked at them, but I couldn't tell you what the companies did. Basically did zero research. Thought I was just going to, be one of those lucky people you see on the news that say, they turned their $5 investment into 500,000. So I thought that was going to be me. Newsflash, it wasn't me. I lost, most of that $400. But I learned really, really quickly that, obviously one of the first principles of investing is to understand what you're investing in. And so from there, I transitioned into more ETF investing, index fund investing, and did that throughout the majority of my investing career up until recently, beginning of 2020 is when I stepped into individual stocks and more towards dividends. But even so, majority of my dividend individual stocks are those growth dividend stocks. So big names like Apple, Microsoft, Johnson & Johnson, stuff like that. So a lot of my money's in those dividend growth plays rather than, your heavy dividend hitters like, Exxon or anything like that. But that's where I really transitioned into that individual stock picking. But at the end of the day, majority of my investments are in those broad market ETFs, or index funds like total US market, total international market. I do have a play in a growth ETF, QQQJ, that I talk about a lot. That's kind of my, people laugh when I say this, but that's my risky investment. If you can call an ETF risky, but compared to everything else I have, that's more of my growth play I have there. So it really transitioned in my investing career from, trying to be the next news article investor that I was going to turn that 400 into 40,000 into, the safer, low risk, but consistent, historically speaking, consistent growth that we've seen with the total markets.
And that's pretty, I like something you mentioned there, right? When you first started investing, you started with $400. And I think that's such a great thing, right? People, I feel now have this kind of mentality that you need to have thousands and thousands of dollars. But here in the United States, we're blessed with free trading. We're also with fractional investing. So you can start off with even as little as $10 a week. And I think that's something people kind of forget. And I like how you said you just got your toes wet and then you saw what you did wrong and you started learning from there. And I also liked how, even though completely different investment styles, it all starts off the same. First, understand where the company is heading, right? Understand what we're investing in. I do have a question though. You mentioned your mom, she kind of dealt with finance when you were younger. Does she also deal with mainly dividend investment, or is that something you kind of brought on yourself after researching and doing stuff like that?
Yeah, I think her investment style is similar in the sense of she does those, index funds, ETFs, but I also know that she does hold those individual stocks. Now, from just, talking about it, I know some of hers are more growth stocks, so would be similar to your style. So I think she's a mix of, all different styles, and just kind of found the mix that works for her. Just as, you found what works for you, as I found what works for me, or anyone listening finds, that strategy or that style that works for them. The dividend investing really just came from research and just my own personal understanding of, yeah, it's nice to own shares in a company while also getting a small little, if you want to look at it, a thank you or a kickback for holding those shares. Whether it be, like in an Apple at a less than 1% dividend yield, yeah, it's not great, but you're at least getting some sort of kickback, or, a higher yield stock, you're getting a little more kickback. But at the end of the day, I do dividend investing, but I'm investing, and I always, teach and preach this, is I don't invest solely for that dividend. Invest in the underlying company. And if they pay that dividend, then that's like a cherry on the top.
Definitely. So I just want to get a little more in depth on your portfolio, right? If you would say, how many positions would you say you have in your account?
Yeah. So, in my, I have a couple accounts. I don't want to mix the strategy. So in my individual stock portfolio, I have 30 holdings. About 26 of those are, my, forever long-term holds, like those we've been talking about, like Apple, Microsoft, MasterCard, stuff like that. I have 4 or 5 that, I bought in the crash of 2020. And those are, travel stocks, airline stocks, cruise lines, that I'm just kind of holding because, I'm up, over 100% on them. So I'm just kind of waiting to just seeing what happens, in the news as things come about and things start opening back up. So, 30 overall in that, but I would say 25, 26 are more of my, hold forever type stocks. And then in my ETF portfolio, it's 5, but I really only add to, or excuse me, it's 6, but I really only add to 3 of them. The first 3 I just bought when I was 18, 19, and I just have been holding those, but the other 3 are really what I'm doubling down on and focusing on, and that's where majority of my money goes. My individual stock portfolio is a $50 a week automatic contribution that it just takes it from my, I don't move a finger, and I put $50 a week in there, and just kind of, let that ride throughout the years, and reinvest and grow that way.
And when you have either in any of your portfolio size, position sizing, it's that something, do you have like some form of tier system? Because you mentioned, right, in your individual, you have about 30 accounts. Then in your ETF, you have about 5 or so. Do you do more like an equal weight amongst positions, or it just depends on how you feel or your conviction towards the stock?
Yeah, great question. Yeah, great question. So, more specifically in my individual stock portfolio, I have definitely a tier system of how I want to put, the different allocations into each holding. A lot of those, I'm younger, like you said, I'm 23. So even though, yeah, I have those dividends that I like, I'm still investing, or I want to put majority of my money in those growth stocks. Yeah, they pay the dividend, but more growth focused than dividend focused. So I have more of the money into those Apples, Microsofts, Visa, MasterCard, these tech companies. I'm very bullish on tech. I think basically everyone's bullish on tech, at least in the long term. So I have majority of that money in those tech stocks. Yeah, they pay the dividend, but they have that capital growth that I want to see, especially since I'm younger and I can take on that risk. If you want to look at it that way, and then moving down, I kind of have it split up just based on my conviction with that company and the growth potential versus the dividend. But again, like I said, I'm always investing solely for the company, the underlying company, not the dividend. But at the end of the day, it's based off of my conviction and where I am as an investor in the sense of my time horizon. So since my time horizon is, 10, 20, 30, 40 years, I want to put more money into sectors that I believe are going to be growing at a faster rate than other sectors. And for me, that pick is tech. And so that's where I allocate majority of that portfolio, or at least a lot of that portfolio, into those tech stocks, like the ones I've been listing here today.
So I mean, it's pretty cool how you within every investment style, right? There's so much different ways you can invest, right? Most people think of just dividend investors, where you have to find this company that pays some ridiculous amount of dividend, right? Looking for companies with 4 or 5% dividend. But then you have a style where you say you're younger. You invest in companies that some of the big names you mentioned have heavy cash flow. So they might pay a nice 1, 2, 3% of dividend right now, but they're also growing themselves as a business. So like you mentioned, you have time. Who knows, in 10, 15 years, the dividend that they can pay in the future will probably be an insane amount just because of the growth they're getting from cash flow. So I feel like that's a whole misconception of dividend investing, or just dividend investing is only boring companies that are paying you a form of dividend and they don't do anything else. But within, right, like you mentioned, there's a whole different style within itself, one that can actually come into the popularity for younger investors. And it's crazy. Like I myself, I'm 28 and I consider myself so young, but now seeing you at 23, it's like, oh man, am I one of the old guys now?
Yeah. And that's the thing, I think that, like you mentioned, like dividend investing kind of gets that bad rep, because what is, when people think dividend investing, they think get the highest yield on my money so I can get the most in dividends, which it sounds great in theory. But when you're chasing that high yield, you're going to get burnt, it maybe next month or next quarter or maybe next year. But at some point, getting that 8, 9, 10% yield sounds great in theory. But over the long term, it's very hard to sustain for, most companies. And so that's why I tell people, I'm focused on that dividend growth investing in those low yield, high growth stocks where, yeah, you get that dividend, that thank you from that company, but I'm still getting that capital appreciation. Not, it's not the same as, an Nvidia or a Celsius or, some of these growth stocks that have been really insane the last year, but you're still getting above average growth with a small dividend that over time, at the rate that Apple has been increasing their dividend and their cash flow that they have, right? They're just cash on hand they have. There's just a lot of potential with that. So I kind of like to see the best of both worlds with the dividend and that growth potential. You couple that together, you hold for the long term, and you can see some amazing things happen with your portfolio.
One market I feel like has been catching my eye lately. We're both seem to be tech investors. One market I'm really excited about is the gaming market, right? We have some big plays like Activision, EA Games there. And right now we're seeing this movement into mobile gaming and a lot of in-game revenue, in-game item sales. These companies are making a nice amount of cash from here. So that's, do you have any form of gaming plays? I feel like that, obviously not advice, but I see this overall gaming growth that is coming and the amount of cash flow that they're seeing. Some of them already pay a nice dividend. I forget Activision, EA, I think they both pay dividends. But I just see the amount of cash flow coming in, and I can see the potential growth of those dividend investments that might be coming. Are those any companies you are looking at right now?
Yeah, I don't have any of them individually now. Obviously, I own, a total U.S.
Yeah,
market ETF. So, within that I own it, but none individually. At the moment, I like where my portfolio is sitting, in terms of holdings. I don't want to, at some point, if you have 150 individual holdings, well, then you might as well just buy an ETF, right? Because,
definitely.
it's a hard to keep track of all those. So I like where I'm sitting at, 30 is kind of my, I had like 36, 37 about a year ago, and I shaved some down just for different reasons. And I like where it's sitting at 30. So as these travel stocks that I bought into, have we'll see what the future holds for those. Depending on that, if I shave a couple of those off, then I would definitely, gaming, I agree, is definitely an area that is untapped still, in my opinion, or at least growing at a potential massive rate. That is something I would look into.
So now that you're happy with your position size, do you still go out and look for new investment stocks or opportunities, or do you mainly just focus on doing research on the ones you hold right now?
Yeah, most of the time, at least currently, I'm just focusing on building up those positions within those portfolios. A lot of the times, like I said, my money is going mainly into these broad market, ETFs,
Mhm.
or more ETFs. That's about 80% in those ETFs or index
Nice.
funds.
Mhm.
And so a lot of my time is just spent, researching not really new holdings per se, but just researching the market, seeing what's going on, what's hot, what sectors are going to be hot, what's hot now, different stocks that are coming up, just to continue that knowledge, right? Continue to learn, not really to add per se to my portfolios, but just to stay on top of investing, for like what we do, stay on top of the news, what's going on. And because, my majority of that money is going into broad market funds, at the end of the day, if let's say Tesla goes down 5%, well, I'm holding it in an ETF that has, if you're doing an S&P 500, 500, a little over 500 companies. So if
Mhm.
one goes down 5%, but three go up a little more, then it evens out. So I'm not really worried about that because of just my portfolio setup, because I'm in those ETFs and index funds. But that doesn't mean that, that doesn't mean I'm not continuing to research my current holdings to stay on top of them, because, if I see something I don't like, or I see an opportunity arising within my holdings, I might add more to that one, or I might keep that on the radar in the future for a reason to potentially add more, whether news breaks about, let's say Johnson and Johnson's one of my holdings, something happens with, in their company, or news breaks about something that would either positively or negatively affect that stock price for right or wrong reasons, right? For, whether that be warranted or not. I can keep Johnson Johnson on the lookout, and, just stay up on it, on daily, to see if, hey, is the stock price going down? Is this an opportunity, to buy more? Because at the end of the day, I also teach, if you see that dip and you like that company long term, don't run. You see that as an opportunity, to double down, or at least buy more than you usually would, because on that recovery, you're gonna obviously make more money that way. So that's kind of how I spend my time researching.
And is there any special tools when looking for like just your ETFs or your positions, just to keep up to news, or what kind of like tools, anything you use to kind of stay up to date?
Yeah, it's more of just reading, like I said, a lot of my money's in that broad market. So it's just reading just overarching investment news, what's going on, as we see the government can, whether they sign deals or whatever, can affect positively or negatively the market, creating it to go up or down. So I'm just really staying up on, overarching news in terms of just, news about COVID, or, news about what the government's doing that can, again, like I said, positively or negatively affect or create the stock price or the market in general to go up or down. So it's really just looking at the overarching things. When it comes down to company basis, I'm more of a fundamental investor. So I'm really looking at just, who's running the company, what's the social sentiment of the company, right? If I'm driving past a Starbucks, for example, is no one in line? Well, most of the time there's always a line. So, obviously that doesn't tell you the full story, right? Just because everyone's in the parking lot of a Walmart doesn't mean that Walmart's making money,
Mhm.
but it's at least a good sign. It's just somewhere to start. So I'm more of a fundamental, just like I said, who's leading the company, who's running the company, what does the management have in sight for that company moving forward in the future, right? Just reading articles about, let's say, for example, Johnson & Johnson, right? I was researching them a few months ago. They talked about, their future, their management's leaning towards tech in the medical field, right? So creating like robots for surgeries and stuff like that, or help in surgeries. And that's something for me, I like personally, because I think that as, people in general, especially Americans, are getting older, the population is getting older, healthcare is going to be a big need. You couple that with, tech, you put those two together, that could be a massive thing. And so I like that for Johnson Johnson fundamentally, right? That doesn't obviously mean that stock is going to be good or that company's going to be good, but at least that you see that their management is trying to innovate and continue to expand or grow the business, not just stay stagnant on what Johnson & Johnson or any company in general. They always, I want to see that growth. I want to see that management lean, or at least talk about trying to grow the company, not just do the same thing over and over again, and then, hopefully try to get different results.
That's pretty. So there are 2 points there I really want to go back into. The first one is, I think this was such a smart thing you mentioned, how Walmart, right, always packed, but that doesn't mean the business itself is doing good. And I like that idea of just seeing how the store is doing. It's just more like an open door. Okay, this store right here is doing great. Maybe I should go and research some more of it, but that's not the final decision. It's not because the store can be giving everything for free. No wonder everybody's here. And the second thing you mentioned was the overall innovation, right? Just, you mentioned Johnson & Johnson, how they want to go into further technology. Obviously, at the moment, that's not going to affect the company in any form of revenue. But if that's a way you believe management is going to go, it can, again, investors need to understand, if they do move into this department, it can be a good potential growth. But right now, we have to understand it's just kind of talks, and it's just showing us where this management wants to lead the company. So it's not something that at the moment could really move the fundamentals of the company. So 2 great points that investors should definitely keep in mind.
But yeah, so like kind of mentioning what you said there, I think it's interesting because, if we look at the pandemic, right, basically it seemed like every single stock took that dip, some worse than others. But you have to, and the point I'm trying to make here is that when you're driving by or you're seeing these Starbucks has a full line or Walmart's full, the parking lot, that doesn't always tell the full picture. With the pandemic, that crash might not always tell the full picture of that company. Maybe that dip was unwarranted, right? Everyone just saw the fear, so everyone just started selling, which caused that dip. But you have to look at it and be like, what's the external factors, or what else is causing this dip? Maybe the company, if we look at the pandemic, maybe this company is a really good company, and they're really not going to be affected a lot by the pandemic, but because everyone just saw red and they saw fear, they sold. And as the famous quote goes, is when they run, we buy, or we come near. And so maybe that dip, or maybe that rise in stock price, whatever, you can look at it both ways. What's truly causing that, right? You kind of have to take that deeper dive into the information and really see what's causing it, and what is causing it. Is that warranted, right? Is that crash, or is that sudden rise in the stock price, is it truly good reason? If not, then maybe you could step in and see the opportunity to buy that dip, or sell a put if you wanted to do that. I don't do any options, but I talk. I see a lot of people talking about it, but you know what I mean. So there's that. You have to always. People always ask me, what metrics do I look at? That's a great question, but I think you can agree that it's not just one, right? We could sit here and say, we like these 5. Say we like 5 metrics. There's always a more to the story, and what your 5 might be different than mine, or those 5. There's hundreds out there you could look at, right? And you have to be able to take different information from different places, couple that together, find your own, research, find your own conclusion, and then, move off of that conclusion you make, by coupling a bunch of different things together.
But yeah, I mean, you mentioned you don't dabble with options, and that's a great thing, right? There's so many different investment styles you can make, right? There's derivative options, and it's great, right? You're doing such a strong portfolio still without having the need to do options. I've like you mentioned, I think earlier on this episode, how there's always that turn $5 into $1 million, and it's like some of the times is based on options, but no, slow and steady is really the way. And it might not be exciting in the short term of things, but buying like that dip in 2020, right? It's like it's only been a year, and some of these stocks are over 100%.
Right.
Maybe back then it wasn't that exciting, but it's only been a year, and now the excitement is like this is a lot funner than doing like those option plays.
Yeah.
You were mentioning about the metrics, right? If you talk, every investor has their own metrics that they follow, and at the same time, I believe valuation is important to some extent for investing. But for me, during my investment process, might be weird, but that's usually one of the last things I look at. I start off with understanding the company, the markets they're in, what type of growth, the innovation. And the last question, it's a little bit more about valuation. And I don't know, valuation for me, I think, especially, I think I'm closer to you where I put weekly investments. I don't have a massive amount of money every week. I put a few hundreds every other day, every other week. So I dollar cost average in my positions. And because of that, I believe that valuation, sometimes I might buy high, sometimes I might buy low. And each metric might be different for every type of companies, right? Most people for like software companies try to look at price to sales ratio. For a more mature company, people try to look at other metrics. And one thing I talk about a lot in this channel and just want to reassess is sometimes just looking at metrics can kind of put us in a box. And I think when you put yourself in this box, you are limiting yourself to so much exposure. I remember the first company I actually invested was Disney. Funny story, I'm a huge Star Wars fan, huge Star Wars fan. And when I first started investing, Disney had just purchased Star Wars. So I'm like, oh man, I knew nothing about investing, nothing at all. I'm like, oh man, this is going to make so much money for Disney. So I bought into Disney. Again, it's later on that I find out that even though Star Wars makes great movies, compared to the amount of revenue Disney makes, Star Wars has no effect on it. All right, so that was my first mistake, right? Not understanding fundamentals and understanding where a company makes its money. Yeah. My second mistake was getting tied up into a box. I was reading all these books, and the one ratio they always mention is the price to earnings ratio.
Yep.
There was this one company. I come from the technology semiconductor industry. So AMD, at that price, it was like $5. And I was seeing leadership was making great moves. They had great plans of new products. They still haven't released the products that they have now, but they were talking about the roadmap. At that moment, they had no price to earnings, right? They were a company burning money, but I saw the innovation and the growth. And because of that, I kind of hesitated on purchasing that stock. And now that stock, since when I first looked at it, is up over 1,000%, I would say. It's more than 10 times, 10x itself. And it's just because I kind of put myself in that box. And it's great, man. And these are stuff I learned throughout the years. Pretty impressive. At 23, you kind of already have this knowledge. So kudos to you. A few more questions. I know you mentioned you're more into like the ETF. That's a good portion of your portfolio. Have you ever thought of dabbling more into like market specific ETFs? I know you're more worldwide. But have you ever thought of looking just more of like a tech ETF or anything? And if not, why is that? Why not?
Yeah, so I definitely have. I really like VGT. Again, none of this is financial advice, but I really like VGT. It's a tech-focused ETF by Vanguard. Like we've been mentioning, I'm very bullish on tech. So that ETF is one that I like, that I buy because of that tech focus. In terms of ETF speaking, that's a little more risky because it is tech, but I like that. And again, I'm young, I can assume that risk and I'm okay with it. So my sector focus, other than the broad markets, I really like tech. Tech's one of the sector that, like, I mentioned, is on something I'm bullish on. And that's really the only one I'm really focusing a tech, or excuse me, focusing an ETF specific, sector to, is that tech sector. Other than that, everything ETF speaking is that broad market. Now I do have that one I mentioned earlier, QQQJ, which is that mid cap NASDAQ ETF that isn't necessarily tech focused, but it's about 48% of its holdings are tech, so pretty tech specific. So those are my really two that I have that are market specific, and they're both pretty much tech. One is a tech ETF, and then the QQQJ is a basically 48% tech focused ETF. So outside of tech, other than my individual holdings that range in different sectors, the ETF talk is more broad market, and then the tech. So that rounds up my ETF is that tech focus, and I'm bullish on the tech. I've thought about a healthcare ETF market specific, but I think it's I'm okay with the tech. I think as we progress as a society, tech is gonna already has and will continue to overstep in that healthcare.
Yep.
So those tech companies are gonna, double down, or at least start to spread across into that healthcare. So I think having that tech ETF is gonna already kind of give me that healthcare exposure that I would have in a tech, or excuse me, in a healthcare ETF. So that's why I just keep that tech ETF by itself.
And I like this one, the QQM you keep talking about. Again, remember, none of this, guys, is advice. All of this is just us having some fun and talk. But the QQM, a perfect example that ETF investing doesn't have to be boring, right? It could just be plain easy. QQMs, like you mentioned, it's most of the stocks in QQQ within a mid cap range, I believe. They have some other plays out there. I think there's QQJ. There's a few out there, again, that some of them go more growth stocks than the other ones more small micro cap. So I know a lot of people right now are just really focused on growth from ARK investments and ARK ETFs, but there's so many great ETFs out there that kind of also have that kind of growth style. How did you find out about QQQM? I think they just launched, I think, either earlier this year in 2021, or I think it was, I forget, January 2020 and 2021 are sort of a blur. So I forget if it was January of 2020 or January of 2021.
Yeah, they came out, I think it was September, October of 2020. So right, right towards the end of 2020, beginning of 2021. And so I don't really remember how I found out about that ETF in particular. I just came across it one day when I was researching, and really fell in love with the way that fund is spread out, in the sense of its largest holding is no greater than 3 or 4%. So it's not like it's really heavy into one company itself. So QQQJ has that potential to, in my opinion, be a great growth fund moving forward. We see a lot of movement. It's that mid cap ETF, so you're gonna get that volatility that you would get, but it's in an ETF form, so that volatility is minimized because you're holding 100 plus companies rather than one or two.
Definitely.
So that's where I don't remember exactly where I saw it like that day, but I remember just coming across it, doing my research, researching it, finding out what it's holding. Do I like it? Just kind of doing my typical research, and finding out that it's something I would be interested in investing in. And that's kind of where the story came about, that I focused on that ETF.
Yeah. So Kolin, this is a lot of great information. Again, thank you. Next, I want to kind of move up into like more portfolio upkeep. And I like talking this in both the ETF portfolio and your individual portfolio. So I know you mentioned right now you have one of your ETFs is the overall tech ETF. I forget what VGT, I think it was.
Yes, VGT.
So let's say market, right? Let's say, I don't know right now your portfolio if they're kind of like equal weight, but if one of them starts to pull away, if it becomes such a heavy portion of your portfolio, do you start to, what would you do? Would you start to trim out of that position and put in another ETF? Would you just let it run? And the same question towards like your individual portfolio.
Yeah, so I let the runners run. So if they're running up, I let them run. And if they, let's say in my individual stock portfolio, if one stock runs up, then I'll just focus on the other holdings that I have and just kind of make that weighting get to what I want it to be. And so at that, if there is that run up, I wouldn't be adding more to it. I would be adding more to make that weighting of that portfolio what I want it to be. And I use M1 Finance for that individual stock portfolio, so it does that automatically for me.
Nice. Okay.
Keeps my the weights what I want it to be. And in my ETF portfolio, same thing. I let the runners run. And if it ran up and the next time I go to contribute, I would just contribute to the other holdings to make it get back to the weighting that I want it to be.
Mm-hmm.
I go into my investments, majority of my investments with the idea to never sell, because it's convictions that I like that stock long term or that ETF long term. So if I see that run up, that's good for me. But there's probably gonna be that if you look at it, the market's cyclical, so it goes up, down, up, down. So there'll be another time for me to get into that one on a dip or something. So I let the runners run, and then I focus to get that portfolio weighting back to the percents that I like to see, and just kind of move that progress throughout the years.
It's so crazy, right? Completely different investment styles and form of holdings, but very similar in mindset. Very similar to you. I let the winners run. Let's say there's a stock that's pulled up a nice amount. Do exactly what you do. When I do my weekly investment, this is not a stock I'm going to buy in because I'm putting money into my market every week. That portfolio grows. So that position, even though it's big right now, it's going to start to pull back.
Yep. Exactly.
And again, it's such a mistake I think I made earlier on in my investment career. So again, it's amazing how you're able to already have this mindset where some of my biggest losses were not from actual losses themselves, but from me selling a position too early and using it to buy something else. And that's just a mistake that I've learned through experience and something I don't do now. And unfortunately, the thing about being transparent in your social platform, you always have critics, right? You always, it's like, Jose, sell, this stock is up so much, sell it now. I'm like, well, first, like I'm going to have to pay some form of taxes on it. Then I'm not here to try to time the market. Sure, it might pull down, but who knows if the pull down is actually going to be lower than where the stock price is at right now. There's just too much unknowns. Buy for long-term investment and just go from there. And very similar to you, that portfolio update is take a quick look. Okay, this one might be a little too heavy. I just won't add to this for some time until it goes back onto where I want it to be.
Yeah. And on top of that, like what you said too, you said like they say sell because it's running up. What if, you said you're not into time the market. No one can time the market. You might get lucky sometimes. You might get lucky a lot of times. But at the end of the day, you can't time the market. So that run up occurs. And, if they say sell, wait for that pullback. Well, what if there never is that pullback, right? Or what if, you sold at, 36 and you in hopes it goes back down to 30, but it never touches below 36 ever again. And so at that point, you lost out on trying to time the market rather than just letting your money run, letting your stock run. And that's where you can see that success that you want to see in your portfolio.
So Kolin, I appreciate the time, man. Thank you so much, guys. If you guys enjoyed the content, make sure to follow him. You should see under the video, you should see his Twitter. You should also under the description see links to his Twitter, his YouTube channel, and other social platforms that he has. Go give him a shout out, guys. And make sure to thank him for the knowledge he gave us. We saw right from anyone can kind of benefit from Decade Investor, from entry to even some of the experienced players. Just try to get another mindset or another look at things. So thanks, man. Appreciate it.
Yeah, no, thanks for having me. And man, I love doing these things and love seeing the different styles that like we've been talking about and we've, said a bunch, is we have different styles, but they kind of overlap, right? The strategies overlap, but the styles or the way we get there is different. And so I think it's neat to come on here and talk about that and learn, and at benefit of the viewer, we can see, maybe someone who liked growth now is like, oh, here's this possibility to maybe get growth and a dividend or something like that, or vice versa. My audience comes here and sees you, and then they click on another one of your videos and they learn about whatever you're teaching, right? Your growth strategies, your growth styles. And so I think that doing these are great to find ways to bridge the gap between, different types of investors, but at the end of the day, our what we do, or the mindset there is very similar. That once you get the mindset down, if you want to go growth, you can lean that way. If you want to go, more dividends, you can lean that way. You can find the perfect medium for each person, which is gonna be different for everyone, but it's always possible.